Hi everyone, welcome to this edition of the Profitable Franchise video blog. My name is John Leavitt and I'm a partner at BDO Canada, where we specialize in helping franchises be more profitable and also help them with all of their tax, accounting and reporting needs. Today I'm going to talk about financial reporting for franchisee profitability. When you buy a franchise system, you're purchasing a business model. The advantage of this is that you're buying a system rather than starting the business from scratch. However, just because you're buying an established system doesn't guarantee 100% that it will be successful. Your success and profitability will depend on how you run your franchise. Regular financial reports on the key information to your franchise operation is an essential best business practice. Today we're going to look at one example of a monthly report that should be a part of every franchisee's monthly reporting, the monthly income statement. Here we have the monthly income statement for the first 6 months of the year. You can see that there's a column for each month of the year up to the end of June, and then a grand total year-to-date column on the far right. The top rows show the revenue broken down by the 3 products. The next section of rows shows the cost of goods sold for each of the 3 products. We then have all of the operating expenses, and then at the very bottom we show the net income. This is your basic income statement. To take this report to the next level, we've also added a percentage column to the right of each month where we show royalties as a percentage of total revenue, cost of goods sold as a percentage of revenue by item, and then each of the operating expense items as a percentage of total revenue. The nice thing about this report is that it shows all of the months in the year together, so this helps us to see trends in the business. As a franchisee business owner, sure, you get this report, but how do you read it? First, let's look at our monthly sales. Here we can see that sales have been the same each month for each product except for February, where there were higher sales for products 1 and 3. As a business owner, you want to understand what caused the increase, because ideally you want to use that information to help increase sales again, or to at least understand when higher sales are expected to happen so you can plan for them. Maybe something happens every February that causes a big increase in demand for whatever it is that you're selling. Moving down, next we'll look at royalties as a percentage of total revenues. Here we can see that they are consistently 14% of total revenues across the board, except for in February when they were 16%. Maybe the increased royalties is okay if sales of one type of product have higher royalties. Or maybe your royalty rate is fixed, in which case you wouldn't ever expect an increase. Either way, check it out. Moving down to the cost of goods sold section, you can see that the percentage of cost of goods sold compared to revenues is the same by product for each month except for February, when the cost of product 1, which is typically 50% of product 1 revenues, increased to 58%. And the cost of product 3, which is typically 30% of product 3 revenues, increased up to 38%. Now remember, in February our overall sales were up, but here we can see that our costs also went up by an even greater amount, giving us a lower ending overall gross margin of 39% for the month. This is why this reporting is so valuable. Generally, having increased sales is a good thing, which is what we have in February. But if our costs are increasing by a greater amount than by how much the revenue increases, of course that's not good. The answer is to look into why the costs went up this month so much more than by how much sales went up, so that we can make sure next time sales are up, we can hopefully maintain our typical margins. This happened to one client of mine. They did an advertising campaign. It was super successful. Sales went way up, but then they didn't have enough product on hand and they ended up buying products from a different and significantly more expensive supplier at the last minute just to keep up with the increased sales volume. So sure, they were more busy, but because of the lower margins, they were actually less profitable. Moving down to the operating expense section of the income statement, here all of the expenses are the same dollar amount and same percentage of total revenues except for wages. We can see that in January the wages were 21% of sales, in February they were 24%, then down to 22% in March, back up to 24% in April, and then again up to 26% in May and June. There's clearly some fluctuation happening here in wages, and there also appears to be a general upward trend. As an owner, this concerns you, so now you could look into it. And of course, now that we've analyzed all of these line items, we then look to the very bottom line, the net income line, to see on an overall basis if we were profitable or not. Because we've already done all of the analysis and the variations above, the ending bottom monthly net income makes sense. Some other best practices for this report, including adding the prior year monthly amounts, or doing the same report but having all of your different locations side by side, so you can see how all of your different locations are doing compared to each other. There you have it, one key report that as a franchisee you should be getting and looking at every month. Thank you very much for listening to this installment of the Profitable Franchise video blog. Please don't hesitate to call or email me if you have any questions or comments, or if we can help you to set up your monthly financial reporting. If you're using the right software, it can be very simple to set these up. Stay tuned for my next Profitable Franchise video blog, where I'll talk about my top takeaway from the 2018 Canadian Franchise Association National Convention. Thank you.